The awareness that investors are acting in the context of a so-called new normal is prompting a revision of investment strategies for a long-term institutional investor like a pension fund. The issue is particularly pertinent. Fagmeedah Petersen Lurie is acting Chief Investment Officer of the Eskom Pension and Provident Fund. She joins us from Cape Town for more on this. Hello, Fagmeedah. Fagmeedah,
hello, Erica.
We looked at your presentation that you gave today, and like many other investors, you're referring to this new normal, low growth, a volatile environment. And what it means, as everyone else is also saying, is a new approach to investing, finding new avenues to secure those returns. What exactly are you needing to do?
Basically, what we're having to do as pension fund investors is reevaluate the way we're approaching the traditional asset classes. Pension fund investments are regulated by Regulation 28, which is a regulation to the Pension Funds Act, and it means that our predominant investment classes are equities, bonds, and some property. And given that equities are now expected to produce lower returns going forward because you're not seeing the growth in companies, we're needing to change the way we approach our equity investing. In South Africa, for the last probably 10 years, we've had a preponderance of the value style approach to investing because it's been fairly successful in achieving alpha. But over the last 2 years, the value style of investing has pretty much failed investors because the markets have not been driven by fundamentals any longer. The markets have been driven really by sentiment and sort of heightened responses to news flow, political news flow, economic news flow. And because of that, we simply cannot rely on the traditional fundamentals to produce good investment returns for funds. So one of the changes in strategy that a fund can take to managing its traditional asset classes is, instead of looking for growth avenues, so growth in the value of the assets, we should be looking to generating income of the assets. Typically, historically, in the old normal, you invested in equities for the growth of that equity. Now we're assessing equities against the filter of what does the dividend look like on that equity. Dividends are real. Movement in dividends are real. They're based on reality. They're based on the turnover of a company. You'll also typically find that dividends give you a fairly good hedge against inflation because turnover of companies are driven by inflation, costs are driven by inflation, profits should be driven or should adjust therefore broadly in line with inflation. And so dividends, as I say, provide a good hedge against inflation. Looking at bonds, they also change the approach and actually invest more for income. Pension funds have historically held predominantly government bonds, and they've held the government bonds for the fairly low but steady yield that they've given. Of course, we've seen that credit ratings have gotten government bond credit rating agencies have gotten the government bond credit ratings wrong. You know, when you're faced with the prospect of Greece and Spain and other countries in Europe actually defaulting on their debt, you get a proper appreciation for the fact that an A rating from one of the large credit rating agencies doesn't actually give you the comfort that you've historically felt from it. And in fact, the new Regulation 28 actually prescribes that pension funds need to review the credit risk of the debt investments that they make. They can pay some attention to the ratings of the credit rating agencies, but pension fund investors actually need to do their own credit assessment.
Fagmeedah, I'm going to interrupt you there. Steve, if you could come in here. So it's very clear, as Fagmeedah says, a changing macro environment, markets are different, also a different regulatory environment. Just your response, and perhaps if you have a question for Fagmeedah on this.
Yes, well, I think it's absolutely right to question the whole basis and to look for new strategies. I was just going to ask to what extent Fagmeedah is factoring in potential volatility due to the rather large foreign ownership of our government stocks.
So Fagmeedah, you've already highlighted some risks on the bond side. Is this an added risk for you?
Absolutely. I mean, we've typically seen that foreign monies come into the country, into bonds, in particular government bonds, for the yield pickup that they present. And with this continuous risk-on, risk-off approach that we're seeing on the part of international investors, that money is hot. It comes into the country, and we've seen the rapid the rapid pace at which it comes into the country, and the risk certainly exists that it will flow out of the country at that same rate, and of course have the fairly dramatic impact on yields in the other direction that we've seen for the last year or two in South Africa.
By contrast,
So
you seem to be seeing
risk.
some
And I mean,
opportunity
that's
on the
one of
corporate
reasons-
bond side. You seem to be seeing some opportunity there.
Absolutely. You know, historically, pension funds have shied away from corporate credit because they've viewed it as risky. But if you consider corporate credit, it's underpinned by the value of the equity of that company. You'd very happily invest in the equity of a listed company. Why not invest in the credit issuance of that listed company, where the equity held by the broad market is actually part of the security of that corporate debt. Corporate debt also typically is covenant rich, which protects the debt holder again. So lots of opportunity there, and corporate credit is typically fairly mispriced in terms of the credit default risk, but you also get a pretty good liquidity premium in the credit yield that you get for corporate credit. So fairly good opportunity there. The key to holding debt, though, is diversification.
Steve?
You need to diversify your holdings so that you are not disproportionately exposed to the risk of any single counter.
Just on a slightly different tack, you mentioned property, Fagmeedah. Do you use listed vehicles or direct? And have you changed your exposure or targeted exposure lately because of the general situation?
Absolutely. Listed property has had a fantastic performance, South African listed property. And at the Eskom Pension and Provident Fund, we hold listed property. And if you look at the typical holdings again of your equity managers, remember listed properties make up a part of the SWIX. The J253 constituted 5.42% of the SWIX on 30 June 2012. But if you did a survey amongst the listed equity managers, they were holding on average 1.82% of their portfolios in listed property. Significant underweight holding in listed property on the part of most equity managers, despite the fact that listed property, as I say, constitutes part of the SWIX, and listed property has had a phenomenal performance. In the 12 months to end of June, it's returned something like 17%, so in excess of the SWIX. But even over the last decade, it's had significant outperformance. So property is definitely an asset class that you'd want to overweight. Obviously, if you've been in it or historically overweight in it, then that's paid off for you. But I believe there is still some potential in the property asset class, particularly when you look at the continuing downward pressure on government bond yields. Because remember, government bond yields are one of the drivers for the performance of the property asset class.
Fagmeedah, thank you very much. It was good to get the institutional perspective. Fagmeedah Petersen Lurie is Acting Chief Investment Officer of the Eskom Pension and Provident Fund.